Welcome to RANsquawk's EU morning briefing, just coming up to 9 o'clock now for Friday the 7th of August 2009. Obviously today is Non-Farms Friday, so that's the main event for today. But taking a recap of what we have seen overnight and where we stand so far. Firstly, starting off in China, given some of the falls or sharp falls we saw late in the Shanghai Composite last week. Obviously lending in China very much a forefront issue. Overnight, an interview, the China Construction Bank Corp's chief executive said we'll reduce new lending 70% in the second half after a surge in loans increased credit risk. Something just worth keeping an eye on. Not particularly market moving though this morning. But elsewhere in the US, President Barack Obama said that actions taken by his administrations have helped stop an economic freefall and that the US may be seeing the very beginnings of the end of the recession. White House does not expect any additional economic stimulus measures in the near term and says any decision on reforming Fannie and Freddie is light years away. White House also said that Obama still believes unemployment rate will eventually top 10%. Again, the expectation today for the unemployment rate in the US does stand at 9.6% today, which we'll see alongside the non-farm report. Elsewhere from the US, noting that US Senate approved and sent to the White House yesterday evening a $2 billion extension to the Cash for Clunkers auto sales incentive program. So all pretty much as expected. The vote there was approval of 60 against 37. In terms of European headlines, ECB's Trichet has done various radio interviews and press articles, all pretty much reiterating what he said in the press conference yesterday. Trichet saying must not abandon alertness and caution and prudence is certainly of the essence. Elsewhere in the FX markets, worth noting some commentary out of Australia. Australia's central bank today said that interest rates could be expected to rise to more normal levels over time should the economy continue to improve, though the current level of low rates was appropriate for the time being. Elsewhere in UK news, all of the UK newspapers and news wires all dominated by the Bank of England's surprise decision yesterday to increase the QE programme by 50 billion to 175 billion. That's all pretty much summed up on the front page of the FT, with MPC raising recovery doubts. We have seen cable off to a somewhat negative start this morning, at last check down around 35 ticks and looking to move back towards the 167 handle. Remember, ahead of the BOE yesterday we were trading up at around 170. In terms of equities, the major story this morning is the earnings report out of RBS. They're pretty much the final of the bigger UK institutions to report. The profit before tax came in at a 15 million margin, with net attributable loss at £1.04 billion. Company impairments though rose across the group to £7.5 billion, and RBS said impairments are expected to remain at elevated levels. They said financial performance over the next 2 years will be poor, and they said that results may not substantially improve until 2011 and a full recovery will take time. At the moment their shares still on the back foot. They opened down 9% and at the moment they're down 16%, so definitely a stock to keep a close eye on, as well as the whole UK banking system. On a sector basis then, across Europe in the FTSE CAC and DAX we're down around 0.25%. It's the basic materials with WTI crude futures a slight negative, followed by the financials that are dragging the indexes lower. So looking ahead then to today, we'll get UK PPI numbers at 9:30 and we'll have German industrial production, that'll be due at 11 o'clock. Canadian unemployment rate, that'll be at 12 o'clock, and then the main focus for today is non-farm payrolls, that'll be due at 1:30. Consensus today on the payroll number from minus 328,000. It is worth noting though that Goldman Sachs did revise their non-farm call overnight, looking for a slightly better number of minus 250, so something worth bearing in mind.